Another episode of Bullish Chips where we talk about chips and only chips. But today we're going to kind of switch it up and we're not going to talk about just SOXL and its price action, but we're just going to talk about how we break down and set up our charts. So first things first, if you're not already subscribed, go ahead and hit the subscribe button and hit the notification bell. That way you're notified about whenever we release new videos. We do release videos every night throughout the week and once on the weekend. But every once in a while we release, I guess, what we kind of call bonus content. So you want to make sure you're notified whenever we do release those videos as well. If you're not already following us on X, make sure you follow us on X at Bullish Chips. There you'll get our real-time entries for our, and exits for our scalps and day trades, as well as our long-term and mid-term trades as well. We also offer other commentary throughout the day that could help out with your trading of SOXL specifically. But if you are looking for just how to break down a chart, that's going to be what this video is about. And the way we break down a chart for SOXL is the same way we break down a chart for any other ticker. So, this can be informative for everyone, whether you trade SOXL or not. So let's first kind of talk about the base of our chart. First, also, we need to remind you that we're not financial advisors. We don't offer financial advice, but what we do offer is our view of the price action and how we are breaking down a chart in our method. So whether you want to follow in our the steps of our method or just use these as another tool in your toolbox to add to your method of trading, that's entirely up to you, but this is just how we view price action. Again, we on this channel usually only talk about SOXL, but these basics for a chart can be applied to any ticker symbol. So, if that's what you're worried about, knowing that we trade chips only on this channel, don't be worried because you'll find that you can apply it to any other ticker symbol. And I guess we'll go ahead and do that as well towards the end of the video just to show you how it does cross over. So the foundation of our charting and trading method is the STRAT. So if you're not familiar with the STRAT, I encourage you to stay with us because it's probably the most easy way to read price action, and it's so simple that you'll know the basics of it within watching a few minutes of this video. So go ahead and stay with us. I will have this document with the different types of reversals and continuation patterns available in the description for this video. So don't worry about totally understanding them right now at this time. Again, we'll go over the basics of it, and then I'll provide more information. There's also plenty of other information on the internet about the STRAT. It was invented by Rob Smith. He passed away about 2 years ago now, maybe a little over 2 years ago. But he did invent this charting method. He does have a YouTube channel that is still live, Smith's in the Black. I'll put a link to that in the description as well. That way you can check out his videos. And like I said, there's plenty of information on the internet, not only about Rob, but the STRAT, which is the the charting method that he developed. Again, it's probably the most simple way I've learned to read a chart after looking at charts for almost 2 decades now. I really wish this was the method that was taught to me from the very beginning. So that's why I wanted to make a video breaking this down, because a lot of people that follow us on X or on YouTube that are trying to apply this method to their trading, they've asked us for more information about it. So again, that's why we're making this video and providing the references that we're providing. Now, the STRAT is the base of our trading method, but for scalping and day trading, we also use price levels to incorporate into or layer on top of the STRAT to give us precise entries and exits for scalps and day trades intraday, within a 1-day time frame instead of swings or long-term trades. So the levels we use are the previous high of day, the previous low of day, the overnight high, the overnight low, and the opening print. And in using these methods, using those levels, we've established a repeatable and proven strategy to measure, your risk to reward, and what the greater chances are of price action going in a direction than another, to give us a method that is consistent, that you can make money from every day. Again, it's not a 100% winner. Other than longer term trades, there are very few methods that are 100% winners. But the key is not only having a good winning percentage, but managing your risk to reward so that your winners are big and your losers are small. So even if you do take small losses here and there, overall you're still making a great profit. So that's the base of using those levels will give you your risk to reward before you even enter any type of position, so you know how much you're risking in a percent and dollar amount, as well as how much you stand to make in a percent and dollar amount. And as long as you are at, minimum 2 to 1, maybe a 1.5 to 1 if it's a really quick scalp and you're going to load up on either shares or contracts. But you really want to look for a 2 to 1, 3 to 1 as far as your risk to reward ratio to give you the best chance of making a profit that's worth your time, right? You don't want to be in here for nickels and dimes, but it's something that you can still make a good amount of money from, right? You don't want to give up the amount of reward you're getting for the safety of your play. So this allows us to give us that precision to still get a big reward on a safer play. So I've kind of talked enough about what the trading method and charting method is based upon. So, let's get into the charts, because that's what I'm sure everyone is here for. We're going to start with just an empty chart. We've got RSI at the bottom. I think that's kind of a common sense type of indicator that everyone should have on their chart. It's not something that, we just sell because we're above 70 on the RSI, or buy because it's below 30 on the RSI, right? There's plenty of times where, as you can see here, it's hung above 70 for longer periods of time, continuing to go up. So if you were selling once you were at 70, you're missing all of this profit basically. So it is a good indicator to have, to add with other indicators or triggers and things of that nature. But it's more of just like a common sense indicator to have. I think most traders, if you're not, I'm not looking at this all day, every day, but you do look at it from time to time to get an idea of, are we close to being overbought? Are we close to being oversold? If it is over the 70 line, we know that we're in euphoria, right? This is a good example because it was, the end of 2020 and then all of 2021, where it was euphoria the whole time because there was a bunch of money being pumped into the economy. So you can see how, you can remain in euphoria for a long time, but at some point you do return back to normal and back to more of oversold type of readings before gaining back up, right? So especially if it's a reasonable, a good stock, right? If it's just some penny stock or some stock that, goes, a company that goes bankrupt, then, you go into oversold and you're just oversold, the company goes out of business. But when we're talking about quality stocks, which is what we should be trading or investing in, at least, when we talk about quality stocks, that's a good indicator to have, right? Now, you may see these numbers 3 and 2. Here's a 1. Those are all, again, part of the STRAT. You can only have 3 types of candles on a chart, right? A 3 where the high goes above the previous candle's high and the low goes below the previous candle's low. A 2, which can be either a 2 up or a 2 down, right? That's where price action goes above or below the price action of the previous candle. So in this case, this candle is a 2 up because price action went above this this candle. This is a 2 down because price action went below the low of this candle. It's not a 3 because it never went back above the high of this as well as below. It just went below, so it's a 2 down. A 1 is where price does not go either outside, above, or below, right? Price action is inside. So some people call that an inside bar. Some people call the three an engulfing bar, either bearish or bullish engulfing. From a strat perspective, those are threes and those are ones, inside bars and bullish engulfers, right? So that's the only thing that you can do, or that a candle can do, right? Is either go two up, two down, three, which is above and below, or one, which is staying in between. So that is essential to understanding the strat and why this method of reading price action is so simple. There's only three things you can do. Now, with those three different types of candles, there are different reversals that you can have. There's about 6 main reversals, right? The 2-1-2, the 2-2, the 3-2-2, the 3-1-2, and the 1-3, right? Then there, and the 1-2, 2 down, 2 up, or 2 up, 2 down. Then there are continuations, right? But we really like reversals within the strat because it gives very clear entries and exits, right? Precise levels that you can buy in at and sell at. Now, whether you sell all of your position when you get to that target or sell part of it, that's up to you, because there is always a chance that it can go past the target. We assess things on a smaller time frame to understand whether we will probably get pushed past the target, but it's very clear entries and exits, as opposed to a continuation where you do have an entry, right? If you had a 2 and a 1, the next candle you would enter once it breaks either below or above that candle, right? But you don't have a target, so you're kind of just allowing it to run, and then using smaller time frames to determine where you want to put stops at to keep from losing all your profit if it were to go back to where the candle opened, if it were to go to back being a 3 or something like that. You don't want to give up your profit. So continuations give you an entry, reversals give you an entry and a specific exit. So that's why we like reversals in the strat. There's also time frame continuity that you want to worry about when it comes to the strat. Let me go down to a day chart. So if you look at the upper left hand part of this chart, there is time frame continuity, right? That's telling you whether the day, the week, the month, the quarter, and the year are green or red, right? Is price action above where is price action above where price opened, or is it below it? So for the day, we will not count the day because the day is over. But for the week, price action it is above the opening print of the week. So Monday's open is the opening print for the week, and price action stayed above that level, which means that week is green. If price action was below the level where the week opened, then it would be red. So the same goes for the month, quarter, and year. So you can see that on SOXL specifically, the day was green, the week was green, the month was green, the quarter was green, but the year was red. And the year was red because if we look, the opening print for the year is up here. This is where, up here. This is where the first trading prices were made at the beginning of the year. And you can see the current price is below that level. So the year is red. So if you just look at it from the day perspective, the opening print was down here, price action was above it, so the day was green, right? So that's one thing you want to look for, is strength in full time frame continuity. If you've got full time frame continuity, then you can have a lot more confidence in going, especially if you're playing options, going out for longer expirations, whether it be calls or puts, just depending on which direction continuity is in. If time frame continuity was all red, then you would want to be buying puts with longer dated expiration dates. Continuity gives you kind of like momentum in a way, right? Or that's not gives you, but it gives you a way of identifying momentum. So with the strat, we want to always remember where our time frame continuity is, as well as whether we are in some type of continuation pattern or a reversal pattern, right? So we can see here there's a reversal pattern of a 2 down, 2 up. When you get a 2 down and then you get a 2 up, we have an entry at the high of the 2 down and an exit at the high of the candle previous to the 2 down. So you can see it ran the strat. Now this turned into a 2 down combo 2 up because you had to have it took 2 candles to reach the high of this strat, but that's a combo 2 down. A 2 down combo 2 up. So they get to be really easy to understand these reversal patterns because again, there's only about 6 reversal patterns. You get to know them very quick, especially if you take time and look at the charts and identify these. Now these numbers are put on here by a script that I use, Thinkorswim. It's a script that I'll also make available in the description of this video, but there are scripts for the strat if you use TradingView as well. They're all available out there on the web and free. You can even find this one on the web, or you may find another one on the web. But there are plenty of scripts out there that you can pick up and use with Thinkorswim and TradingView. I'm not sure if there are any other ones. Those are the only 2 I'm aware of that will automatically label these candles 3s or 2s, right? You can still identify just by looking at them, but it's very nice to be able to just quickly look at a chart and see, especially where something's kind of close and you're looking at it like, did this go above this candle, without having to bring out your cursor and put it on and see what the high was and what the high of this candle was. You just take a quick look and you can see, oh, this is a 3, it went above and below. So it's something nice to have, but not something you need. Another part of the strat is broadening formations, and that's talked about down here, right? And that's just really connecting highs to higher highs and lows to lower lows, because that's what you can see on any chart gets formed. Here's a broadening formation, so here's a high to that high, and then here's a low to this low. So you can see price has been in this broadening formation. It bounced off of there, couldn't quite make it back up to the top, went back down, didn't quite make it to the bottom, but you can see doing all that created another broadening formation, right? So now that's what price action is bouncing in between. So we're seeing here, we did get a little bit of a push down in the month. Is it going to come back down and try and bounce off of this broadening formation, or is it going to reverse and continue up to the top of this broadening formation, right? So that's another major part of the strat. So that's what we're going to break down here today, is how to draw the broadening formations, right? How we color code them, so that if you are watching our other videos throughout the week and our weekend videos, you understand what the colors are. We don't need to talk about them in each video, going in depth of what color each time frames is represented by. So we'll go over those, and then we'll also kind of touch just a little bit on our precision trading for the scalping and day trading, but I'm going to make another video for that, so that I can go a little bit more in depth on that, and the videos aren't too long, right? So again, I've talked enough. Let's go ahead and put into practice what we're talking about. Now, one thing we do need to recognize is how price has moved for any stock, right? Any company, any ticker symbol, since the year 2020, right? We all know what happened in 2020 through 2021, and then we had the big bear market of 22. We had a huge run up starting at the low of 23 to 24. So we've had these bigger swings than we ever had before, right? If we look back in the past, you see bigger swings. Now these might be exaggerated by SOXL a little bit here, just because of the importance of semiconductors in the world these days. Prior to 2018, semiconductors were used, right? They've been around for decades, but the gaming community wasn't so big. We didn't have cloud computing. We didn't have AI. So now we get into a lot more use of those. So chips, SOXL, SMH might have a little bit more exaggerated swings, but you can see basically the same in all other quality stocks, right? The same type of movement. So I like to base most of my trading starting with like the end of 2019, right? So even if we were to draw a broadening formation here to here, we can keep it there. We'll use from 2018 on, just because although it did break through it, it came crashing back down. Generally, we don't leave broadening formations out there that price action has broken through, right? Because it makes it basically no longer valid at that point. But there's certain times, and you get a better feel for this as you trade with the strat, get more time trading with the strat, of what broadening formations you might want to leave around, just because the way that price action went through it, right? What might have been happening at that time. The broadening formation still may be valid in the future as time goes on, as price continues to rise. So you get a better feel for that a little bit when the more you trade with the strat. But for the most part, we don't leave broadening formations out there where price action has broken through them. Okay. So my personal approach is to break things down starting from the highest time frame, which would be the year. And in this case, there's not really any broadening formation that we have, right? The price action just basically just goes up, up, up. We did have a 3 here, so this could be considered a high, and then we had a low, and then we go back to the next high, right? Oops. But that's a huge. It'll take years to get there, so we'll leave it out there for right now. Unless chips just explode and go berserk, it'll take a while to get there. So, but just for the color coding sake, I do label these white. The yearly broadening formations are labeled in white. From time to time, so we don't like to use trend lines very much, right? I like to use horizontal lines more. But from time to time, it may be useful to draw a downtrend line, right? So we'll just use that as our downtrend line. This is white. Actually, does that? The high is 74.07. This is 74.21. So it needs to come off of here. And this needs to go there. All right, so we'll change this. So that went high and low, and that's another high, and then it went low. So we'll edit this, make it white, and we'll make it dashed, large dash, to indicate that it's a downtrend line. So we went off of this high, and there was a low. A 3 is just a high and a low incorporated into one. So it went above and then below. So this was the high. It went and made a low. It came back up and made another high, but then we had a 2 down, which basically locks this in as being a lower high. So if we take a line and draw it from the high of this high to the high of this high, it's downsloping, so that means it's a downtrend line. So again, it may take some time to get there. Not sure if we would make it there this year, maybe 26, depending on how the market goes. Maybe even 27 if we just move sideways. But at some point in the near future, next 2 to 3, maybe 4 years, we should be approaching this yearly downtrend line. So it's something that we do want to leave out there. As far as a lower broadening formation, so this went high. This is a low, but it's higher than this. Yeah, we didn't have anything that would go below. If it did, you can see price action right here is like already at 0. So even if there was a broadening formation that went down here, it'd be negative price territory, which it's never going to trade in. So it would be no point in putting it on there. So now that we have our major broadening formation and our major downtrend line from the year perspective drawn, we go down to the quarter. And this gets a little bit more juicy because we've got a little bit more action to choose from, right? So we can see that this was a high, and that price action went above this, but then went below. So we've got a high, and then we made a low. So then after you make a low, you look for the next higher high. So we go up. There's a high, another high, almost a 2 down, but it's still continuing to move higher. And then again, it went just above this candle. So we mark this as our quarterly broadening formation, and we mark that yellow. So year markers are white, right? Quarter markers are yellow. And you can see how there is a slight difference to how price action when looking at a quarter chart is from the year, right? So we'll go ahead and leave it out there. The year, again, there's some that you leave out there that price action went through. This is one of those because it just barely poked through it and then pushed back down. So it does appear it's respecting it, and we leave it out there. So we'll look for a lower broadening here, and that would be this low that then had a high and came back down to another low here, right? And you can see the further we get, it's going to get into negative territory. So we'll leave it out there, but after some time, it's going to be one that is basically going to be ignored because it's going to be below zero the further down into the future we get. All right. So we've got our first set of broadening formations from a quarterly perspective. Let's go ahead and look for another high to high. So we've got a high here that then went 2 down, but then went back above. So we have our high, we have the low that then starts back to highs that reaches this high. So we end it there and we change it yellow, and we've got another quarterly broadening formation to the upside. Now, do we have one to the downside? If we go from here to here, that's upward sloping, so that's not a broadening formation, that's more of a support line. If we go from here to here, that's definitely a support line. If we go from here to here, that's still an upward sloping line, so it's not a lower broadening formation. If we take this low to this low, there's another lower broadening formation for us. All right. And again, you get the concept, so it becomes a lot quicker to do, right? One thing we do have to look for, do we have a downtrend line? So we go from this high, what's our next high? That's here. So no, we broke through that easily. We don't need to draw any downtrend line from the quarterly perspective. We don't have one here because we don't have another quarter candle going down, locking in this as a lower high. So we don't have any downward sloping lines or downtrend lines from a quarterly perspective on this chart. So let's go ahead and get down to the month, which is going to give us even more opportunity for broadening formations. Just simply, it's more candles. We could take this high, I'm sorry, not that high, this high, that then went low, that then went up to here. We can leave that out there. From the month perspective, we make our broadening formations green. So we've got year is white, quarter is yellow, month is green. Again, that's a pretty steep broadening formation. Not sure that that'll hit anything, right? From there, we do have the low, and we're looking for a low that's lower than this, and that would be this low, right? Because then we get a 2 up there locking in that low. So we'll change this to green. And just like that, we've got this lower broadening formation, right? Now, we got the 2 up, and then it went 2 down to make another lower broadening formation. But again, now we're in negative territory. It's never going to trade there. So we'll go ahead and remove that. All right, as we move on, we can take this high. Now the next high would be there because it then went 2 down, locking in that as being a high before going to another high. So because price action went through it so much, right? It's not just like a poke through and come back down. We're going to remove that because it's no longer valid, right? It's playing within these larger broadenings at this time. No longer that lower one. It broke through that handily. Now it did come back into it, but it more broke off of this wider broadening. It bounced off of this widener broadening than it did any, oops, right? That's an upward sloping line, so that's not a broadening formation. We have this to here. That's another broadening formation. So in the midst of this broadening formation, right, this larger one here, we had a low that was then breached by another low. So it did make a broadening. And you can see once we bounced off of this to create this broadening, even after it rejected, it came back down and just bounced off of the new one that was made, right? So we're not going to leave this one out here because, again, it takes you into negative territory, but it just displays how You know, you do get these bounces. Even if they come through this older one, you look for the newer one to be that support. So we'll remove that because, again, it goes into negative territory. We can take this next one and we can leave that broadening formation out there, because many times you'll see from the month perspective, you know, the candle will go through here, but if you switch back to the quarter, you can see how the quarter doesn't go through the quarter broadening formation, right, as much. So on the month perspective, it goes through a little bit more. So you can leave it out there. It will come more into play once you get into the future, right? And so that's the only reason why I'm really leaving them out there, because price action didn't break them. But right now, for now's price action, that's a pretty steep broadening formation. And you start to get a little line happy out here, right? You can continue to draw them and continue to draw them. So for me personally, I like a little bit cleaner chart. We have this wider one and then this one right here. We've already got the quarter and the year right here. So to break through those two would be pretty hard at that time. So we're just going to remove it for right now. Otherwise, we're going to have a whole lot of lines on here. We'll take this one because it's the most recent out of this range. You know, so here's the one going off at the top of this range. Then we range for a little while. Then the most recent one from the top of this range. That's what I usually like to do. Instead of getting too level happy, just take the most recent one from a point where there are multiple. That way you get it, and you can see in the future how it starts to line up with this one, this older one. So as opposed to the other one that still had gaps in it, real big gaps in it, really far into the future. So again, there's kind of a somewhat of an art to this. It's a repeatable, a repeatable method, but there are nuances to it that you'll get with time. It doesn't take a lot of time, but you will get the nuances. So now the other thing we want to look for moving forward are further high to higher high. Right, there's one, but price action goes clear through it and trades in both directions above it. So that one is definitely negated. Oops. This one is negated, and I accidentally duplicated it. All right. Sorry about that. So then we've had those. Let's see about this high to this high. Again, price action just wicking through it. So, you know, we might leave this one out here, right? We'll mark it as our monthly. That way we know. So then if we take this high that, you know, this broke down from and find our next high, that puts us here. So remove, oops, undo, remove, we want to edit. And I think the reason why I went to remove it is because now that we have a newer one that it did wick off of, it's probably safe to remove this. We'll leave it out here just for this time being. We'll see how messy it looks once we're finally done with all our broadenings. But again, price action didn't go through it too much. So again, here's a little bit of that nuance. We'll go ahead and leave that out there. Leave that out there. You know, if we break above this downtrend line, it gives us another, kind of a target on a longer term perspective to get to. So then we'll want to look for a low that has a lower low. That's not there. This low does go to our April 7th low, so we'll go ahead and put that out there as well. All right, so we can see that that's a pretty firm broadening formation because we have the month and quarter like basically overlapping. This one's pretty strong here because they're not overlapping, but they're very close. You can see how this is probably more of a flimsy broadening formation, this one right here, because it's older and newer price action did show that it could go to a higher level. So we don't just ignore it once we get here in the future, but we know that it could be, not as hard to break through. as, you know, like this one would be hard to break through, or this one would be hard to break through to the downside because of how close they're either overlapping or how close they are. Okay. So again, a little bit of the nuance to it is how close are those broadening formations from different time frames, right? We also have this one that if you were charting, you know, with the strat, you would have been totally ready for April 7th, right? Like I was waiting for April 7th to hit, because not only did we go to this broadening formation that was created earlier in 2024, but, you know, again, these two were gone at that time. They weren't there. These were just created when this made this low. So this one was the only one that was there. Let's go ahead and remove that and remove that. So we had this old one and this new one, right? So somewhere around here, we should be seeing a bounce. If you're looking at it, you know, from this perspective, we don't have, you know, you're starting to trade early into 2025. You've got the lower high here on the month, you know, starting the downtrend. You get this lower high again, continuing the downtrend. Once you get that, it's like, okay, where are we targeting to the downside? And you had this monthly broadening formation that even before you get to March, oops, wrong way. Even before you, so in February, it's like, okay, we got the lower high in January. We're going, it looks like we're going to go down, you know, inverted hammer, red inverted hammer. Where are we going to go to? And you could map that out, and you could see that, you know, sometime around April, May, this broadening formation right here and this broadening formation here, we're going to cross. And, you know, it looked more towards May, but we got it in, the price action got there in April, and, you know, we unloaded. We got a bunch of leaps, we got a bunch of shares, because we knew, you know, even if it wasn't the bounce that we got, which was so quick, it would either be sideways, you know, slightly down more, maybe. We did get pretty low down here to $6 and something cents, so we're almost at zero already. You can't go any lower than zero, and they're not getting rid of SOXL, so we knew we weren't going to go, you know, below zero. This is, aside from just being almost at zero, hitting these two major broadening formations was a major time to see that, okay, even if you didn't buy at the low, right, we did, because we got down on the week and daily time frame and saw where the low was, right? We'll get into that here in a second. Even if you were waiting for the monthly time frame, you knew that, okay, we got the hammer, it bounced off of these two broadening formations. As soon as price action goes above this level, I'm in, right? Because that's a 2 down, 2 up reversal. I'm in. I know where my target is. I know where my extended target is. I know where my other extended target is. And you have basically what's called a pivot machine gun, which is a whole bunch of candles in the same direction that you retrace, right? From a month perspective, it's not thin structure, but you have all these candles. It's your pivot and then machine gun back up, right? And do basically try and emulate the same thing that all these months did, but in the upward direction. And so far, we've kind of gotten that, right? So it just shows an entry, you know, broadening formation, confirming the bounce, entry, exit, 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 right? So again, this is very, very simple how to read price action. You don't need EMAs. You don't need VWAPs. You don't need Ichimoku clouds. You don't need MACD. You don't. I mean, all of these other indicators, which are great if you want to analyze previous price action, they're great to use, right? But the advantage that the strat gives you is it gives you what the next price action has the highest probability of doing, right? Rob Smith did not do all of that work for nothing, right? He literally went through every ticker symbol in the stock market, right? And he has all of those videos on his channel as well. So if you want to see it in action from someone other than me, there's Rob's channel. There's plenty of other strat focused channels where this methodology works, right? And you don't need all of the other stuff. Now, can you layer in other indicators to make you feel more comfortable, especially when you first start using the strat? Of course. But the more you use the strat, you'll see you don't need them. And they really just analyze previous price action and not giving you a guide as specific as what the strat will give you. Yes, MACD may cross over, which may tell you, hey, I should be entering around here. The strat is going to tell you exactly what price to enter on and what price to exit, or what price to start taking profit, right? So that's the difference between the strat and traditional charting. So now that we've got the month, let's go ahead and get down to the week. And depending on the time frames that you're trading, you may not even get down to this level. If you're just trading shares and for longer periods of time, you may only want the month strats and broadening formations. But if you're getting down, if you're trading shorter term, or if you just want even more precise entries on your longer term trades, that's when you come down into these lower time frame charts. So we'll start. I don't want to get any more weekly broadening formations than the last couple of years. If you do, you just get a whole bunch that price action goes through, or that are just crazy high and crazy low because of what was going on at the week. So we'll start here. The first thing we can see is we've got the downward, the downtrend, right? But we did break above it. So, and it's not like we just wicked through it. We've got, if we leave this here, we've got 1, 2, 3, 4, 5, 6, 7 weeks of price action above it. So we're going to take that out of there. This actually makes a broadening formation because it has an upward slope. So our weekly broadening formations, we use purple. So we have that weekly broadening formation. We have another downtrend, but that's obviously broke. We have another downtrend that's obviously broke. But we have this uptrend here. So we've got high, high, low, high. Right? And you can see that's exactly what this price action rejected on in the future. So we'll just do the same type of thing. If you were charting here at the end of 2024 using the strat, you would have this broadening formation, and you could see that if price goes up, you would be able to know where it was going to. And what did it do? It tried to reject a little bit before it, but then pushed back up and rejected right exactly off of it. So we've got that broadening formation to the upside. Do we have any to the downside? So this is a, oops, come on, Thinkorswim, think. This is a low that then went high and then low again. So there was that, and for a while it did respect that, right? But then it finally broke through, and you can see with the momentum that it broke through. So when it breaks through a broadening formation, a lot of times it's with force, right? Here's with force, broke back through with force, right? There's not these little tiny candles most of the time. You get the little tiny candle, but then when it actually breaks through, it's big movement, right? It's big move. It broke through with big movement and then continued that movement, right? So it fell through when it fell through. Now there were certain things that happened out there that triggered that. We don't get into political views, but that triggered that, and we could mark it, but we're going to go ahead and remove it because price action went so heavily below it, and there's probably going to be a better one for us out there. So if we look for a more downward sloping one, we could see this low to that low that cuts through as well. But if we have this low, then a high to this low, we got that weekly broadening formation. And we could see that if you had charted it at the time, that one mixed with this monthly broadening formation converging right here is just another indicator. Okay, this is probably going to be a bounce point. If we go down, this is probably going to be a bounce point. And you had this broadening formation from all the way up here, right? We didn't wait till it was down here to draw it. We drew it as soon as we got the high and the lower low that was locked in by this lower high, right? We put that in, and then that gave us, another mixed with this monthly broadening formation, this monthly broadening formation, this weekly broadening formation. Okay, if we go down, we're probably going to go down and bounce around this point. And that's exactly what we did. Right, so look for a couple more here. This would be a downtrend line. Again, we broke through that. Oops, remove that. Let's go for something else. So we've got, all right, so we've got the low, and then so we've got a high. So we're looking for another low. So there's the high and then a low, and then we go high, and then it went low before going high for this 3. So price action did go through it, but not too handily. Let's just take this high, then the low, and go up to the next high, and that's there. So, we can leave this one around. Probably will, just to have it out there as an early indicator of possibly price action slowing down. Again, the broadening formations aren't always reversals because you can break through them, but it shows where price action will slow down and there will be a fight, right? So those breakthroughs that we talked about are often preceded by these. Okay, it even though it rejected and didn't go fully down, see, that's the fight right there. We're trying to break through it here, and then finally when it does, it explodes through, right? So the fight here, trying to break through it, then it finally explodes through, right? So having these broadening formations give you a sense of, okay, this is where I need to start looking at my, if I've got contracts or if I've got shares, I've got to look at my position and say, do I need to set a stop, right? Are we at a threat for a reversal? Do I want to add more? Do I think this is just a place where we're going to do some consolidation, some bullish consolidation, and continue up? That's the decision you have to make, but it tells you the level at which you're going to have to make that decision. So until you get to that, you can not be sitting there worrying about the price of the stock the whole time, right? So we've got these broadening formations filled in, and that gives us a breakdown of our price action, right? It shows you. It went up here. So this quarterly broadening formation that was set way back here in 2020, after we went back up, that's what we went to, and we rejected. We got the fight first, right? Remember, we get the fight because it could have continued going because there's this monthly broadening formation up here, but you get the fight. So here I need to maybe set my stops. Here I may want to add more. Who knows? You got to look at the price action on a lower time frame and make that decision. But that tells you at this level, I need to look at it from that perspective. And we ended up rejecting down and going down, bouncing off basically this quarterly broadening formation that was formed way back here in 2018, 2019, right? Basically bounced off of that, made a new monthly broadening formation, went back up. And because of the broadening formations that were set here, we rejected, making a lower high on the year perspective, then making a downtrend line, right? So we know that we've made this bounce. If we, continue to go up, look at where the downtrend line is intersecting with the broadening formations. That's probably where we're going to get a rejection, right? If we make it up here by the end of the year, we'll probably get a rejection. If not a rejection, it's going to be the fight, right? If it takes until 2026, once we get over here, that's probably where we'll get a rejection. The deeper we get into 2026, then we risk not even making it to the downtrend line, just getting stuck here where these two broadening formations intersect. But say that makes it move sideways, then we continue to push up again. We're going to run into more resistance here as we get into 2026, right? So that just shows us where price action is going. If we're going to go up, this is where we're going. If we're going to go down, this is where we're going, right? And it's easy enough to see, plain as day. Now, if you are looking at things from like a quarterly perspective, it might get a little harder if you've got weekly and monthly broadening formations in there, right? You can always remove them if you need. But you can see from a quarterly perspective where price action is at, right? And over this time, these broadening formations will, show you trading zones. So when you apply these with the broadening formation, so you see how this monthly broadening formation, you got the 2 down, followed by what's called a failed 2 down because it went 2 down, but then pushed back up not only to make a hammer, but to go green. You have a failed 2 down, which is a greater indicator that you're going to have a 2 down, 2 up. You know that that's coming most likely because you're hitting this broadening formation here. This monthly where 2 monthly broadening formations intersected along with the weekly one. That's why this turned into a failed 2 down. These were all drawn before this price action ever even happened. But it showed you what was most likely to happen once you got to this level. right? So that's why the strat is such a great way to easily break down price action. It's very simple, very, very simple. And you might think, Chris, that's too simple. Well, that's what you want from the market. You don't want complicated. You want simple, so it's easy for you to trade, right? If you want a complicated market, you can make it complicated. But it really breaks down to just from a trading perspective, watching price action, right? Now, if you're investing long term, buying shares, you know, buying private, going to private equity, you're gonna want to look at fundamentals, financials, things of that nature. But if you're just looking for a pure, just how to read pure price action and understand where it's been and where it's going, more importantly, where it's going, the strat is a beautiful thing. So I will go into a little bit here. I touched on the triggers and targets that we use for scalping and day trading. So let me just touch on that. I'm going to make a whole nother video for this that will go more in depth. But basically, what we use is, let me get out the right marker here. So say we were getting ready for Friday's action. This is Friday. We would have the night on Thursday night, we would have marked our previous high a day, which I mark with an orange solid line. PHOD's previous high a day. We mark our previous low a day. Oops. PLOD for previous low a day. We make that orange and solid. Right? And then we have our, let's go to a 15, our overnight high and overnight low, right? So overnight high was here Thursday night. All right, and we just marked that with an H in the bright blue, and the overnight low was right here. We'll mark that with an L and just make it the bright blue. Okay. So the last, if you remember, we'll just go to the notes. We have the previous high a day. We've got the previous low a day out there. We've got the overnight high and the overnight low. The last one that we use, you can't mark until the day opens, but it's the opening print, which is just where price opens that day, right? On this particular day, Friday, the price action opened right here. So we'll just leave that as the peach color and just label it OP. So we've got our opening print, overnight high, overnight low, previous high a day, previous low a day. Now, if you want to get a little bit more precise, you can also add in the 4 hour, the high and the low of the 4 hour candle, the second 4 hour candle of the previous day. And I'll label that, oops. I will label that just with up because it's a trigger to the upside. 4 hour. And then the low, which also happens to be the previous low a day. But, oops. Put it in there. Price level. So this is the trigger to the downside on the 4 hour. And we'll make it gray. Okay. But we can see very clearly mapped out where those are. And if we go in, now, if we're talking about scalping, right? Let's look at what price action did on Friday. So basic rules are price action above opening print, you're going calls. Price action below opening print, you're going puts, right? Because when people look at their charts, if price action is below the open, the day is red, right? Their numbers are red on their charts. If it's green, the numbers are green on their charts. And so when they're green, they're more enticed to buy. When they're red, they're more enticed to sell. And we can see, if we spread this out and look at the day's action, price opened and pushed down to what? Essentially the overnight low. And because it couldn't make it to the overnight low, that showed a sign of weakness for the bears, right? It couldn't even make it to the overnight low, which the bears had got it to overnight, so they should have been able to get it back to in the regular trading day. Because it couldn't make it down, it then went 2 up, right? And price action went back above opening print. It also was back above, which you can't really see because they almost overlap. But remember, we made this gray up. That's the trigger for the 4-hour time frame to the upside. And again, with the precision trading video that I put together, you'll see how we mark our triggers and targets for the 4-hour time frame, the day time frame, the week, the month, the quarter, and the year. But basically, that triggers the 4-hour strat to the upside. The 4-hour strat has a magnitude of the previous high a day, but just from a scalping perspective, once we break above opening print, you want to buy calls, and your first target is going to be either the 4-hour trigger to the upside, but since it coincides with the opening print, your next trigger is the overnight high, and the next target is the previous high a day. And look at what price did, right? Now you could take a risk if you're just looking on the 5-minute and just buy as soon as price action goes above opening print, but you want to make sure you have your risk to reward built out. You've got your risk here because, right, if it goes back below this candle, then you've just set you don't know what you're doing, basically, right? The price is just going back and forth. So you would want to get out. You wouldn't want to really risk anymore because at that point you're below the opening print and you're risking going below the overnight low. So you'd want to set your stop here. That way you stop out knowing that your reward is up here. So your risk would be from here to here, but your reward would be from here to here. So it's like a little over a 2-to-1 risk to reward ratio. That's reasonable to take. So you can take the price action as soon as it goes above. We really want to look for some type of higher low above here for the the bounce to show that being support. If we get down to the 1 minute, let's scrunch things up a bit. Go back to the open. All right, here's your higher low, just like that. So within that 5-minute candle that was just green, and then another 5-minute candle that was green, you get the higher low. So if you were scalping, you get down on your 1 minute, you see price action come above, you wait for the higher low, you enter here. Now your risk to reward is even better, right? Because you're entering at the top of this candle, right? You want to wait till you lock in this higher low, which means you have to go 2 up. So once price goes above, this candle closes. Once this candle opens and price goes above here, you enter right here. You buy your shares, you buy your call options, you do, whatever you're doing, you buy it right here. And your stop is set here, right? Because you don't want to make a lower low. Now you can give yourself a little bit of grace because you've got your opening print and your 4-hour trigger to the upside right here. So you can have your stop down around here if you want, knowing that your reward is all the way up here. You can give yourself a little bit more risk, or you can just enter on the 1 minute and then monitor the 5-minute and just know that, okay, I've got, come on, Thinkorswim. And just know that, okay, I've got to the bottom of this candle, right? Which is the lower low on the 1 minute candle. But you can see how it gives you such precision that you could have loaded up on contracts here and just exited once you got here. Take your profit real quick and easy. Or you load up on contracts here, you exit half of them here. You keep the other half trying to get to this target. And you can see it tried getting up there. It almost did. And so you would know that, after this, 4th, 5th, 6th final attempt to try and make it and it's not doing it, you probably want to go ahead, the whole time you're moving your stop up to the lower high. So I'm sorry, to the lower low. But if you want to get as much profit as possible, you can start to read the 1 minute. It gets a little messy, but once you get your lower high, lower low here or here, you could have exited, right? And then you don't have to worry about stressing over, oh, now we're back at overnight high. Is it going to be support? Is it going to break through? But you can see how it uses those levels. So it's very easy for precision trading, right? That it would have just been the opposite to the downside, right? If it would have went below, your first target is overnight low, second target previous low a day. Then you get into the notes that we create, and then we start looking at our day and week targets for our extended targets on any scalps or day trades that may go beyond the initial targets that we have for them. So again, I'll get more in detailed about our precision scalping and day trading in another video that I'll try and get released this weekend as well. But I just wanted to put together kind of an updated video. I released one of these very early on. Mic wasn't that great. You know, my presence on YouTube wasn't that great as far as, you know, speaking confidence. I'm not a YouTuber. I trade, and I just thought that this method was important enough that I wanted to, you know, tell some people about it more than just the few friends that I have that enjoy trading as much as me. You know, you start talking to enough people that don't care about trading like you do long enough, you start to bore them. So I don't like to bore people, and there are other facets to my life as well. But it's just something that I thought was important to get out there, to show how easy it is to chart in a way that uses a method that can be repeated over and over and over for consistency, because that's what we want, right? You can sit out there and gamble, right? Or you can just go to a casino if you want to gamble. But if you want a proven, repeatable method to consistently make money, this is the easiest way to do it, right? And I'm not knocking any other person's method. They may have their own method that works for them. This is the one that works for me. I'm just putting this out there because there may be someone else this works for that the other methods aren't working for. And I just really hope it just helps at least one person. So if this helped you, you know, make sure you give it a thumbs up. Even if you're not going to use the strat, but this helps you just understand breaking down price action a little bit better, you know, give us a like. It helps the channel grow. It helps this video spread, and hopefully, you know, if it doesn't help you that much, your like on the video will help it reach someone that it does actually help more. So you know, please give us the like. If you enjoyed our breakdown, if you've looked at our other videos and, you know, checked out our tweets, you know, and it's something that you think you might want to follow, make sure you hit the subscribe button and the notification bell. That way you're notified whenever we release new videos. Like I said, we release at least 6 videos a week, sometimes some extra bonus content like this. So it's all free. I'm not asking for anything, no memberships or I'm not selling merch or anything like that. Just want to get this out there. So if you like it, give it the thumbs up, subscribe. I hope you enjoy the rest of your day, whenever you're watching this, or night. And I hope this helps in your trading. So again, if you are more interested in some of this information, I've got references in the description of the video. But past that, I hope that everybody just has a great rest of their day.